Hello, everyone. Welcome. It's your finance geek here today, Denzel Rodriguez. Welcome, Kingdom citizens, Velocity Banking students, and subscribers. If you're new, welcome. We're going to be talking about, can Velocity Banking increase my credit score? We're going to look at some scenarios and prove whether that's true or not. And I have my friend Brittany Green, if you remember her from our last live stream, which is titled Velocity Banking and Credit Restoration. We talked about different principles and rules of building and growing that credit score so that we can get closer and closer to actually doing velocity banking and implementing those concepts as well, so you can get out of debt really fast and build capital, build wealth, and a great credit score. So I'm going to turn it over to Brittany Green. We're just going to be asking her some questions. If you have a question, please leave a comment. I'll be monitoring the comments here, and we'll go from there, all right? So I'm going to turn it over to you. Thank you for being here.
Yes, of course, and thank you for having me again. Hello, everyone. I missed you guys because it's been a while. It has definitely been a while. I think we came in 2019, so what a great way to actually start the whole new year and start the new year with some updates, some tips and tricks, and some amazing things that we have going on. So today we're going to be updating you guys on Denzel's score and his journey and how the different timetables that we had and where he was at that time and why he was there at those times to where he is now. So let's go ahead and dive on in.
All right, let's direct our attention to the board.
So I think we're on the board. We're good now?
Yeah.
All right. So when we first started last year, you were at an Equifax score of 667, Experience 690, TransUnion of 732, and your utilization was in the mid 20%. So I think your situation was extremely unique for a few different reasons. Because number one, you were already applying the velocity banking strategy to what you were doing, as well as you didn't really have any negative items on your report. You just had some closed accounts, but those closed accounts we found that weren't reporting negatively, so we wanted to keep those on your report so that you had it didn't take away any of the good history that you did have. So our focus was more so just kind of clearing up some marks on your report, as far as like things with your name, which we're still fighting them, and helping with your utilization. So throughout the timeline, what you'll see is that your score did a little bit of fluctuation. And the reason why your score did a little bit of fluctuation is because of how you were applying the velocity banking theory, meaning your utilization was going to vary at certain times. Now, most of my clients know that I will have them focus on a 10% and below area consistently for a few months so that they can, steadily have increase. But with yours, you were more so focused on, let's see what velocity banking is going to do to my score as I go throughout. So as you can see, you started here with the 20% utilization.
And that was in what month? Do you remember?
This was in October when we started.
Okay.
This was in October when we
October
started.
2019. Okay.
Yes. Then by November, you had brought your utilization down to, and I think it was at the very, very, very beginning of October, because I was traveling back down here when I was actually talking to you. So by November 13th, checked your score. You were at a 6% utilization, Equifax score of 701, Experian of 727, TransUnion of 728. And then by January 10th, which was recently, in about 17 days, I think it said you can update your report so you can see where your score is in all three areas from that. But as of January 10th, you were at 17% utilization, 695 with Equifax, Experian 733, and TransUnion 727.
Okay. So we can definitely see how velocity banking can help, but there's also, that downside of, the credit score fluctuating pretty fast. But if you're in my situation, for those that are watching, where you're doing velocity banking to either pay off debt or you're simply trying to just build your credit lines up, you may not be so concerned about the score, right? But let's say I want to do something, right? Or if I want to buy a home. So I know you have a client of mine, which is now your client as well, where she is trying to obtain a property.
Yes.
So, is there times where velocity banking might make sense to put it on hold
Yes. Yes.
if I need to acquire something such as a truck?
Yes.
You're trying to get a new home. So for anyone watching, let's say you're doing velocity banking, you're on a roll, you got your debt tool, you're making things happen, you've knocked out some bad debts, you've got your cash flow up, credit score is looking better, but now you're in a position where you're looking to buy a home, you need to get a new car, maybe your lease or maybe you just paid off your car and you're like, I don't want it no more, you want to give it away, whatever it is. Maybe there's a window period. So my question is, how long should that window period be? How much time do we need to give ourselves to get that credit to where we need to get it to? And then once we do acquire what we want, when do we pick up velocity banking? Right after, or should I hold on? So
Okay.
I don't know if you want to
Yes.
raise the board or.
So I can raise the board. Well, not really because I can keep it. Just simply because if someone is in your situation, then definitely they're 9 times out of 10 not necessarily caring too much about the score itself. Just because if the credit bureaus, they run off of behavior. So what you're doing consistently, and of course when you're doing things with velocity banking, you're probably running up your credit at that time so that you can take care of that debt, and then you're slowly paying it off and paying it down. So because of that, you're always going to see some fluctuation of being in the 700s and then going back down a little bit and then coming right back up because of how you're utilizing that tool. But if you aren't utilizing that tool, or you need to put it on pause, the safest way I want to tell you to do, especially in your case, I could see this happening in about 3 to 6 months. For someone who has their score fluctuating pretty low, so say for example they're in the 700s and it drops down to the low 600s, you want to give yourself about 6 months to 8 months to get yourself back on track, meaning pay that balance off, get under 10%, because that's the area that you want to stay under. Consistently stay under 10% for those months, meaning that doesn't mean just stay there, because they want to see you consistently using behaviors. So I tell you, hey, take a small bill. It might be a small membership, maybe like $10 or $20 a month, depending on your credit limit. But staying under 10%, because I know some folks don't have really high, high windows of 10% range. But in this case, a lot of times you will, because if you're practicing velocity banking 9 times out of 10, you'll have a high line of credit. Yeah. So you'll be able to, take a $100 bill, put it on there, and then pay that on that bill. I'm sorry. Make sure you guys understand this part. Take a $100 bill, put it on your line of credit, right? That bill is going to come out of that line of credit each month, but you're paying that off. You're paying that down each month, right? They want to see that consistent behavior of you keeping that under that low amount, so 10%, right? So if I have $1,000, I want to keep it under $300, okay? Because 30%, that's the main rule, and then 10% under $100 every single month. That makes sense? Okay. Once you guys are doing that for about 3 to 6 months in your case, or 6 to 8 months in someone else's case, depending on how low it has dropped you, do that. They're going to see those consistent behaviors. Tag on. Your score is going to hit a mark, because what they're looking at is not only are they looking at the negative items in your report, but they're looking to see how are you managing the credit that you have currently. So they're always seeing you fluctuating up and down because of velocity banking. They're not going to automatically assume velocity banking. Right? But if you're doing this consistently, put a bill on every month under 10%, you're good to go. Okay? Because they're saying, okay, well, for the past 6 to 8 months, you were doing good. You were only using about $100. Okay, not a problem. We'll, be more than happy to give you this new line of credit, this truck or this house, etc. Right afterwards, after you get the big purchase, your credit is going to take another hit, because you now have this new line of credit, this new home, this new mortgage. I know many people, after they get a home, they now see the mortgage tag on to their report, and they're like, well, how did my credit score drop so low? You got to now keep these same behaviors up for another good 6 to 8 months to a year, depending on how low it drops your score. Then you can tag right back along onto velocity banking.
So let's write some of this stuff down so people stay engaged with it, so we don't get the right rules down. So we were talking about the credit score fluctuation, right? And you also mentioned the time period of when I'm trying to obtain something, and then when I should pick it back up in terms of the velocity banking concept itself. So I just want to, take a minute. Let's write some things down. Obtaining.
I think it did. Y'all.
Well, my people know I don't know how to write.
Okay,
either,
I was gonna say I did not master.
They're all right. They're all right.
So in your case, because you were fluctuating, safely between the 680s to the 730s, yours would probably take about 3 to 6 months of good behavior.
If I want to do something.
If you want to do something.
Okay, so here's a prime example. I have 2 car leases that are finishing this year, 2020, before the summer. So between May and July is when these car leases are going to be done. So I've got all of the rest of January, February, March, April, right? So about a 4-month window here. What should I be doing for sure right now?
Keeping your balances under 10%.
Okay, so I should just kind of, should I just pay everything off? Because I have the ability to just pay everything off right now.
Yes, you can definitely do that, but when you do that, you still have to use it consistently because they need to track behavior.
So my auto pays.
Yes, keep your auto pays and just continue to pay it off each month. So maintain between a 10%
and under.
And under, yes. Okay. That's what the down arrow is for. Maintain 10% and below. So when you're looking to obtain, if you're floating between the 680 to 730s or above, 3 to 6 months of consistent behaviors of it being under 10%, you should be okay. Okay? 600 to 680, if you're floating between there, give yourself a little bit more time once you bring your balances down to under 10% of obtaining or maintaining 10% or below of activity between 6 to 8 months. Something that you can do is take a small bill, a small subscription that you have on auto pay, have it auto pay to your credit card or your line of credit. Once that's there, you can go ahead and then pay that down, pay it off, get it out of the way, and then let it keep going each month. I know there was a specific question that we had that we're going to get to about having lingering balances that we're going to get to soon.
Okay, let's see. So just make sure you write the keep your auto pays.
Yes, keep auto pays.
So this is for me, guys. This is like, here's an example of someone that I don't have real debt, right? I have debt from Velocity Banking where I'm basically running all my bills on a 0% card and I'm not paying it off. I'm letting it go the whole 15, 12-month window of 0%. But what she's telling me to do right now, since I have the cash, I have the money, no bad debt, might as well just bring all those balances down, keep the auto pays, and just pay it in full, correct? Which leads to something that I heard at a speaking engagement recently where there was another credit professional that was telling the audience to keep a balance on their credit cards. And what they were going to the extent of saying having, like, actually paying interest on these balances. Now, all my students, all my subscribers know that we don't like paying interest.
We
period.
don't.
And you're on that same
I'm definitely
vibe.
on that same vibe.
So what is that concept that person, was that valid? Or do you have a different mindset against that?
I mean, that's if you like wasting money, but I don't like wasting money, so I don't want to just throw it away. But there is a little bit of truth to that, but it's a trick that you can use. So, of course, you're going to be paying off your balance monthly, but here's the way that you can do it. You can do what's called the 15 and 3-day trick. So, when you buy something on your line of credit, that same day, you don't want to go ahead and just immediately call them and pay them off because it had no time to actually sit on your report and they didn't have time to post it. You want to give them a chance to post it. So what you're going to do is 15 days before the bill is due, that's when you want to go ahead and pay half. Okay? Pay half. Sorry, y'all have a problem with talking and writing at the same time. Then 3 days before it's due, you want to go ahead and pay the other half. And that's how you pay it off within that same month, but you give it a chance for the system to calculate 2 payments being done in that month, and they're looking at you like, hey, okay, this person is actually responsible. They have a nice little trick. It's kind of tricking the system into making it seem as if you made 2 full payments. This way you get it paid off monthly,
Don't
but
pay interest.
you don't pay interest, but you also let it post to your account so that they can see that you're actually using it and calculate the behaviors that you have going on.
Gotcha. Okay, that sounds good. Should this also be applied? In my case, I've got these 0% credit cards where I basically max them out. I'm paying the monthly minimum. Should I pay more than the monthly minimum?
Yes, especially since you're looking to get something done within the
Right.
next couple of months, you definitely want to do
So
that.
just knock them out. Okay. Should I keep a balance, an existing balance, or bring it to 0 and then just whatever I have on auto pay?
Bring it to 0,
Bring it
auto
to
pay.
0, then do auto pay. Gotcha. Okay, sounds good.
And then do auto pay, because this is of course within your case. For someone, for example, such as the other case that we were speaking about, where she's looking to purchase a home, she wasn't applying the velocity banking trick at the time.
Right.
She was starting from scratch of, hey, I just need to improve my credit, and I had her on this same thing of 15 days due, pay half, 3 days due, pay off the other half, and maintain between 10%, and do this every single month. And it was increasing her score, just continuing to increase her score. So now, when she gets her home, she knows she's going to take a hit, but she's going to go back to doing this, getting her score back up to where she wants it to be, taking out her heloc, and then starting the velocity banking trick. So if you're starting from scratch, you're not already doing the velocity banking trick, and you have to start from scratch, understand that you want to maintain between 10% on your cards that you do have, meaning that may mean you need, if you're maxed out, you need to figure out a way to get down. I know you're helping them with that. Get it below 30% to start. Then make it your next goal to get it under 10%, and then maintain it there, utilizing this hack and stack trick together. And that's how you're going to see that consistent growth. But they want to see those consistent behaviors, because especially if you're, coming from a place of maxed cards, they want to see, okay, well, here's where you were in the past. Let's see where you are now.
All right, so then let's talk about the majority of the viewers in the house that are nowhere near 10% utilization.
Yes.
They're in the 70s, they're in the 80s, and 50% utilization and up. And so let's create a scenario where someone does not have a line of credit, which is a lot of people in the room, in the house right now. A lot of people do not have their debt tool. They want to do velocity banking. They watch a couple videos on velocity banking with a credit card. So they go apply for a credit card and they get $5 grand, 10 grand, nothing really. They've got already 90% utilization. Now they just added more, right? And this is where velocity banking gets really, really tricky sometimes. People watch a video and then they go do it right away, and then they mess up, right? So for those who, let's just write, do not have a line of credit, and so no line of credit, credit scores, let's say between 600 and 700?
I'll say 632. Let's go for 632. Okay. It's a good number that just kind of came out.
That's like okay. All right, so we got you're in the mid 600s, low 600s, no line of credit. You have decent cash flow, okay? You're making income. So you're cash flow positive. We'll just write that. And you're thinking either velocity banking with a credit card, right? By simply opening up another one and doing a balance transfer.
So they have a credit card now, right?
Like they have, let's write, credit cards are maxed out. They have credit cards that are maxed out. Let's utilization, let's write above 75%.
Okay. So 100 or 70?
They're maxed out on their credit cards, but their utilization is like 75% because they have other debts too. You know what I mean?
Okay, so now if they're maxed out on their credit card, they're going to be at 100% utilization.
on their overall credit score?
If all of your cards are maxed out, you're going to be at 100% utilization.
Okay.
So I was going to speak
if
to that. Now, if you add on another one, it's going to lower it. So if, say, for example, if they're maxed out on their $5,000 card and they add on another one, another $5,000, that's going to knock this 100% down to 50%.
Okay. So let's say someone has multiple credit cards. They have a car payment, a home, student loans, but these are, they're not maxed out. They're getting paid down.
So now student loans and cars, etc., that doesn't calculate into your utilization.
Great information, guys. Look at that. We're learning something. So
yeah, your utilization is strictly what your credit card, revolving credit
debts.
Yep.
Gotcha. All right, so let's put it at 75%.
Okay.
Utilization. Yeah, let's put
I'm
it
over here doing that, and I got the magic.
I got the
eraser here.
Yeah. So 75% utilization. So which means that they do have some room on some credit cards.
Yes.
Right, whether it's one or two of them. Do you recommend someone does the velocity banking concept with the credit card, which can work technically, but if we're trying to get to that line of credit really, really fast, should I either do the debt snowball concept where I'm just paying it down and not adding to it? Because when we're doing velocity banking, money's going into that credit card, money's coming out.
Yep.
And more stays in than comes out. We get that. But do you think we should disregard that, do debt snowball for a period of time to potentially get a line of credit and then go really fast once I have a line of credit?
Yes.
Okay, so
absolutely. Because at this score and at this utilization, I don't think anyone's going to be willing to give you a high line of credit.
True.
Especially because they're looking at how you manage what you currently have. And they're looking at the behaviors. How long, especially when we start speaking to FICO and Vantage. Now, that's something else that we're going to talk about. So I'll go ahead and put that on here now. When we speak to FICO and Vantage, I actually just made a video about this. So there's a difference. And when someone is looking to give you credit, 90% of lenders are still looking at your FICO score, whereas 10% are starting to look at your Vantage score. Vantage scores are typically Credit Karma, things that the banks offer you to view your reports monthly, because it's multiple bureaus that they can show you at a time, typically TransUnion and Equifax, okay? Whereas FICO scores, you typically have to pay for those. So if you have an Experian.com account, then you know that you're typically paying that on a monthly basis to view all to view all three of your credit scores. So there's a difference between Vantage and FICO. So Vantage will allow you to gain a credit report a lot faster than FICO. FICO, they want to see more so of the consistencies of your behaviors. So this one is going to typically take you to develop a really good, behavior pattern, about a good 6 to 8 months. Whereas Vantage, they're pretty much showing you after 30 days that you have some type of activity. The Vantage score was created for folks that were establishing credit and they had absolutely no idea, what they were doing. This was something to kind of help them get started. Okay. So typically a lot of folks will say, oh, hey, well, since I got my Vantage score, this has to be where I'm at. But it's typically a difference of about 30, 50, sometimes 70 points between the two, right? Because again, this one is your free model. They're looking at different factors than your FICO. So a lot of times when you're looking at your scores and your utilization, they're looking at the Vantage score, or your Vantage score can vary because this one looks at how long you've carried that balance. So if a lender is looking at your Vantage reports, they're saying, okay, you have this 75% utilization, but now it's hurting you because you've been carrying it for 3 months, whereas here it may not be hurting you as much. Okay. Right? So there's a little bit of difference. So my first thing would be to tell you to look at both scores. Understand your FICO and your Vantage may be a little off. This one actually fluctuates a lot more than this one does because of how long you carry your balances. Right. Okay, this is a huge factor of how long you carry your balances. So the first thing that you want to do is after you looked at your Vantage and your FICO score is focus on the snowball method to bring that down to 30% first. Okay, so I'm always going to say 30% first. That's the first goal. Because once you're there, that's a safe zone for both FICO and Vantage. It's a very, very safe score or safe area because they want to make sure that you're under that first. Then you start working towards the 10% mark. Because once they say, okay, you were able to get it down to 30, okay, you might be responsible. Let's see how much further you can take it. Then you take it down to 10% and you maintain it there for a good 6 to 8 months. Then you'll see, of course, your score heading up. Then you can start going on to the velocity banking area from there.
Gotcha. So this 30% and that 10% is just regarding your credit cards, guys. So we just learned that the car loans, the student loans, your mortgage, I guess anything that ends with loan is not counting towards your utilization.
That's only going towards your debt to income ratio.
Your debt to income
Yes.
ratio. Your DTI, which is another big thing in terms of
huge.
getting approved for another credit line. So it would be wise for a period of time if you do not have a line of credit, this is what I teach my students, but now I actually have some factual stuff to back that up. Whereas before I was just kind of hey, this makes sense, But now I can actually prove to you guys this makes sense. Do debt snowball, okay? Debt snowball, making extra payments if you do not have your debt tool yet, right? This makes sense. My friend Joel Flores is in the house. He will verify this as well, where it really makes sense to do that for a period of time, say 6 to 8 months. Let's check the score. During that time, that 6 to 8 month period, I can also, based on the credit line that I'm shooting for, whether it be a heloc, a line of credit, or maybe a credit card at, being my last option, to also establish a banking relationship.
Yes. Definitely establish a banking relationship. I actually have another one of your clients who came to me, and this is something that I had her do because she's at that stage in the 700s where she can go out and get a line of credit.
Okay.
But one of the things that I had her do was ask the lenders what it is that they're looking for. Because sometimes, like you said, DTI is a huge thing, utilization is a huge thing. But another piece to the puzzle that we don't necessarily look at is collections. Right? Things that are in collections, what negative items that you do have on your report that can hold you back from getting these. So by simply building that relationship with the bank or, speaking with them upon terms of what is it that you guys look at directly before they run an inquiry on your report, it helps in the long run because she was able to find out so much more information by building that relationship and asking them questions. So now she knows exactly what it is that she needs to do before going out there, putting herself out there and getting denied. Because just like you said earlier, there are people within the high 700s who will still get denied based on, several factors. So it's good to know those factors before going in.
Great. That's good information. Let me just recognize some people in the house, and we're going to jump to the next topic here. So we got Joel in the house. Hello, Jeremy, Michael Johnson, Gregory Knight, Ronald. If you guys have questions, let me know. How's our audio doing? I guess it was a little struggling before. Is it okay?
You know how when it gets super high and they make
and
that
then
static?
It creates a little static? You got to see.
Does it.
Okay, that's all right. Billy, how are you? Johnny boy, how you doing? Hello, Jose. Okay, Robert, how you doing? Bella says, I like her. She's very knowledgeable and a good teacher.
Oh, thank you.
Okay. Robert G says, save the cash flow and in a few months use the saved cash flow as a line of credit. Chunk a payment toward a bill, pay car payment, insurance, etc. via credit cards and pay credit card via the checking account. So
that may work.
So you want
for
to
lowering the DTI.
Lowering the DTI, but that might not be so good with the utilization. Okay.
I mean, well, paying off your credit card, of course, anytime you're paying off your credit card is good.
Yeah.
But as far as like chunking on such as a loan, a car payment, insurance, etc., then that's
So let's
if I
say-
understood the question correctly.
Yes, I'm gonna write it out. So let's say I cash flow 500 per month, and we're giving ourselves a 6 to 8 month window to get a line of credit, right? Let's just say this is for people who are in the preliminary pre-game work to Velocity Banking. What Robert is getting at is he's saying, don't even use this cash flow yet. Save it. And maybe in month 4 or 5, make a big chunk towards a debt
Okay.
to then get the line of credit. Or would you recommend doing that on a monthly, showing behavior, showing?
Well, if you're gonna do that for credit cards, you need to be making a payment monthly because you want to
Okay.
definitely show behavior. But if you're doing this to a big loan or something like that, that's just gonna help with your DTI.
So it's so guys, saving the cash flow and then making one chunk payment is, we'll just say, good for DTI. But that might not be enough to get the debt tool. So
When it comes to your credit cards, because they want to see those consistent behaviors. That's what
So-
they're looking for.
So option 2 is pay monthly, right? Debt snowball on your credit cards. So the credit cards are typically the smallest debts that people have. You know, then it's the car, then it's the student loan, then it's the mortgage, then it's the personal loan.
So they could actually
Things like
hack and stack these. I like to call them hack and stacks because you can save up your money and do this for your your loans. Again, that's good for DTI because you want to make sure that that's at a safe level. I want to say, especially when you're looking to get big loans, if it was something I was studying for qualifying ratios, where they want to see you at 28, they want to make sure that the new line of credit that they're going to provide to you is not exceeding 28% of your income.
Okay.
So, because, and this especially goes for homes, etc., because they don't want to they know we're already overwhelmed in debt, so it's
Right.
we want to kind of give you guys a little leeway. So that would be good to chunk and help with your loans, but you can also, hack and stack if you have the cash flow to do so, getting your credit cards down, building some good behaviors on that, because that's where they really look for.
Hashtag hack and stack.
Hack and stack, that's what I love to call it. I put that in the book. Oh, did you know you were in the book?
I'm in the book?
You're in the book.
Oh no, I gotta read that. You just made a book
Yes.
recently. When?
Yes.
When did it drop? Because I think I saw a picture on
Yes,
Instagram.
it dropped at the end of 2019, and they just started shipping out. They just got them on the 22nd.
Beautiful. So
And
I'll be sure
Denzel's
to-
in the book, y'all. Denzel's in the book.
I'll be sure to drop a link definitely on this video when I go back to edit it and all that good stuff and put it in there. Make sure people are reading, you're educating, you're watching the material, you're doing the work. So here's where I would also question Robert's example here is from a math perspective. When I make extra payments per month on an amortized debt, the faster I hit the amortized debt, the less amount of interest I'm gonna pay. So
That's true.
I think from a math perspective and from a amount of interest that I'll be paying, I think I would still rather pay per month if I'm gonna, if I'm going after lowering the DTI.
Oh yeah, you still definitely want to keep paying on your loans because if not, they'll hit you with the payment history.
So I'm paying it monthly, right? The minimum payment. But I think if I was in this position, I think I would still take my cash flow per month and add it as an extra payment just because of the way the interest is calculated on amortized debts. But I guess maybe from what his perspective is, you build it up maybe 2,000-3,000, show a huge payment, and maybe that might have a bigger effect on the interest.
It does though. 'Cause you showed them the chart for. I never can say that word correctly. You gave me a new word to say it. Amortization.
Schedule?
Yes, I always say it so wrong, amortization. It's always extra. But I was playing with the numbers in one of the charts, and I'm like, if I put that on there, that huge chunk made the interest go down that much. So it
You
does.
know what? You're right. You're
It
right.
does. It's
Let me
huge.
go back on what I just said, because if let's say I have 6,000 right now,
Mhm.
and 500 times 12, that's $6,000.
Mhm.
If someone pays 500 per month on a mortgage, right, for 12 months, that'll equal $6,000 in extra payments, versus the individual that takes $6,000, let's say from a debt tool, that $6,000 in the first month, right, of that wherever I started, it's going to be more.
They're gonna
save
shift
more
it beautifully
than the person that pays it monthly. But in this particular situation, with in terms of trying to get access to a line of credit, if I'm in a position where I don't have initial capital, so that doesn't even exist. So let's say I don't even have initial capital to work with, saving up that money, sacrificing a couple months for the sake of trying to get closer to the line of credit or lower DTI, then I don't know, maybe that might be better. But
keep paying as normal, and then once you've developed something huge, you can definitely do that. But this is definitely the way to go, the safest way to go for someone who's just getting started
and trying to get the line.
You gotta start, you gotta crawl before you walk.
Okay,
sometimes I wish I could just start walking, but sometimes you gotta crawl before you walk. So this will be the safest way to go.
All right, the next question is, what are the benchmark percentages on your installment and revolving accounts that make the biggest differences on your credit score?
So the difference, okay, so installment and revolving, they work two separate ways.
Write this stuff down.
So, sorry y'all, gotta erase this part here, but I think it was up there for a good amount of time. Y'all should have that written down. So when it comes to installment loans, they're just loans. So once they're paid off, they're done. So installment, as long as you're paying on it each month, then you're gonna be okay. Because installment, whenever you're making payments on it, it goes more so towards your on-time payments. So your pay history. I was trying to get that out.
And DTI?
Yes, and DTI.
Okay.
Whereas your revolving goes towards, I know I spelled that all wrong. I cannot write and talk at the same time.
No, you spelled
I
it
did. Oh, we getting there. Whereas your revolving, the safest place to be is anywhere under 30%. But I like to take it the extra mile because I like overachievers. So I'm gonna always say, but as long as you're 30% and below, you're gonna be good no matter what. But if you want to be that overachiever that I know we all want to be, you want to keep it under 10%. Anything over 30%, they start docking against you. And that's just with revolving. And revolving typically goes towards your utilization and payment history. And sometimes DTI.
Okay.
PH is pay history and then DTI.
Okay. Joel says cleaning your credit report is a must.
Definitely.
Right. So in my case, my name is spelled wrong a bunch
That
of
was
times.
it. And I don't know why they are not.
Still haven't fixed it?
I do not know why, because that's something that I've been.
Which bureau is that?
TransUnion.
TransUnion is tripping. They got
tripping.
me. My middle name is spelled with an A instead of an O, right? So that's about it. But like something like that, could that have a big effect?
Yes.
Okay.
It can, because they can now tag on someone else's information.
Yeah.
Good thing it's your middle name and not your first or your last name, because that's usually when it's the worst.
Well, whenever I get stuff in the mail from Citibank, they're spelling my name as D-E and S-E-L.
No.
Yeah.
That's the first one that we worked on, so they fixed that.
But
they changed. Now they're hurting your middle name.
Now they're hurting my middle name. But
because when we first started,
mail.
it was your first name.
I got mail recently from I think Chase or Citi, and they're still playing games with me. They're calling me Denzel.
You know what? It's not just them we probably need to reach out to.
Yeah,
We need to reach out to the pre-approved systems.
The pre-approved systems. Explain that.
So pre-approved systems, I know when we all turned 18, we started getting those pre-approval letters in the mail. Hey, you've been pre-approved for $1,000.
So it was a pre-approval thing.
Okay,
from
then
City
yeah.
or Chase. Okay, so yeah, keep going.
So when it comes to pre-approved systems, it's the fourth credit bureau that no one really knows about because they don't necessarily report the normal way, right? You have to actually call in to them to either get your name taken off the list, to get your name put back on the list if you want to keep receiving pre-approved offers, and it's safe for up to 5 years. So for 5 years, you can be taken off their pre-approved list. They won't send you anything, right? They purchase the information from TransUnion, Experian, and Equifax, and other different agencies to now send you these offers to get you housed in. So we can reach out to them now to figure out how to get you, and that's going to be the next thing, because I haven't actually had to reach out to them for a misspelled name. So this is going to be a good thing to add to the books.
And those pre-approval companies, how valuable are they in terms of?
They're valuable because there's things such as like Bank of America, Chase, your normal big banks, they go through those pre-approved systems to kind of lure you in.
Okay.
And if you accept those, then that's how it gets moved on to the next stage of things.
Okay, let's see. Question from Future Wiz. Is it possible to get a low interest credit card 4.2%? I don't think so.
What? Yes.
Yeah?
Is it possible to get a low interest credit card?
Like the APR on a credit card.
Yeah.
The lowest I've seen was like 8.
Yeah. 6. I mean, not likely. I mean, your credit score has to be like beautiful.
Beautiful.
It's astounding. I mean, you have to.
Okay. All right, so that.
But there are people out there with very, very low interest rates out there.
Yeah. Usually the credit unions.
Yes. Oh, credit unions
have the
beautiful.
best, lowest rates.
If you really want to build credit unions are the way to go because they have less fees involved. A lot of these big credit card companies, they have all these hidden fees and things like that really hurt you in the long run.
Robert G. Says, thanks for the feedback. You guys rock. I'm just very fortunate to apply for and receive an unsecured line of credit for 20 grand. I'm starting to pay down debt in February. Before your channel, I was lost, but now you are found.
Now he found.
Let's see. So let's go into your services.
Yes.
What you sell, how you work. Let's break it down for the people that have not watched that video before.
Yes.
Because someone is saying, how much does one-on-one coaching cost?
Okay.
So that's directed towards you.
Yay. Well, so it's a little bit different. I actually did change up some things for 2020 to better benefit the clients depending on what they need. Because in some cases, you might be a Denzel where you may not need the negative items getting removed from your report because you don't have any, right? So that's going to be a little bit different that we'll go through. I have to actually review your report. So for anyone who's watching here, you will, because we'll drop a link where you can schedule time with me on my Acuity. It'll be for after February 1st because I am moving. So I will be out of commission for the next week and a half, just kind of getting things prepped. But you can reach out to me on Facebook, Instagram, etc., and I can, do quick polls and things like that for you guys. But I do actually charge now for the consultations, but that's why I didn't put that on there because anyone who's coming through Denzel's channel, you get a free consultation where I get a chance to look at your report.
Just throw an L in there.
Oh, there we go. There we go. I'm getting better at this. I'm going to be a champ. You get a free consultation where I'll be able to look at your report and help you decide what it is that you need, whether or not you just need coaching services to help with your utilization, or if you're going to actually need the whole restoration package where we're working to get negative items off. We're working on your coaching, getting a personalized coaching plan for you together like we did Denzel. And we'll go from there. But first, we have to start with the free consultation for anyone who comes through Denzel's channel.
So they just have to say my first name, last name.
And they always do.
Okay.
Every time they go, hey, so I saw you on Denzel's channel. I was like, oh, that's that Denzel. So that's all they have to do.
Okay. So free consultation. How long is it?
Consultations typically 10 to 20 minutes, if that. If we're
Not
having
long.
a good, yeah, not long.
Straight to the
Conversations,
point.
yeah, straight to the point. And that's why I said for the next week and a half, they can call me. I'm not call me. They can write me on Facebook, Instagram, and say, "Hey, I saw you on Denzel's channel," and I can do a quick pull for them there. Where I don't even, I can just look at your report and tell you what you need from there. I can literally do that within 5 minutes, so or less.
So your website is
Financials. LLC.
LLC.com.
But I would say put my email address there so that they can read. Because if they go through my website, they're gonna have to pay.
Gotcha.
So if you put info@crownfinancialsllc.com and say, "Hey, Denzel sent me," then I'll send you my Acuity link, or we'll get started right away with.
So
crownfinancialsllc.com, and they can reach out to me from there.
Boom.
And I'm on Facebook, Instagram as Brittany Green.
And then, so what is the cost of like let's say a full-on program? I'm in the weeds. I need help, type of thing.
So if you need full-on restoration, it's typically once. Why do I keep doing that? We changed it up just a little bit. It's $150 to get started, and then it's $70 a month after that. This is going to take care of mailing, because I have to mail off your letters, printing, and getting it notarized, because I like to get it notarized. On a monthly basis, this also covers the monthly coaching, because you will get monthly coaching and updates.
What does that coaching look like? 1 call, 2 calls?
1 call.
1 call a month.
1
30
call.
minutes?
Sometimes less than that, because
we're talking credit, guys.
Yes.
This isn't velocity banking where I gotta like teach you the whole thing. So credit's more like, hey, do this on this day at this time, and you write it down, you do it.
And I say some people don't even want to do a call. They sometimes are like, okay, you just send me what I want. Email me, text me, send me a voice note. Like, we do it all.
Okay.
I'm
That's
FaceTime,
great.
all that.
All right, and then the 150, that's like to get all the
started.
reports. And then do they need to pay for a subscription service?
Yes, a subscription. So it's a subscription
Which
link.
one do you need them to buy? The Experian, right?
Oh, no. For that, they don't have to have Experian. Because I can read both reports. I know how to read Vantage and FICO, and I like to educate folks on that. So if you have Credit Karma and then the free Experian account with your thing, with your Experian report, and then you have TransUnion and Equifax on another one, not a problem. We can use all of those. And then they could also use the free annual credit report that one time to get it accurate. So but I'm still going to need something on a monthly basis to be able to monitor and look at where their progress is going.
Okay, so you don't really need people to buy something in addition to what. So I have a lot of credit professionals out there. I've seen them. They're like, okay, you have to buy some. I forget the names, but they're. I know Experian was one of them. And there's another one out there where it's like it's like $1 to sign up, 7 days is free, and then you got to stay on it for the amount of time that.
And a lot of times it's because they don't know how to necessarily read the Vantage and the FICO scores, because it is different. Gotcha. And the different things that it weighs. But I will be honest with you guys, I got told off one time, and that one time was enough for me. It was when I first started in the industry. I started with an actual company, and she was like, "Why did my scores drop?" And I'm like, I don't know, but I should know. And that's when I started digging deep, and I'm like, oh, because this is Vantage and this is FICO and this is different. And so a lot of times it's because they don't necessarily can't read or don't want to read the differences. I don't mind reading the differences, especially if it's going to save you money. But a lot of people will say, hey, I just want to go ahead and purchase Experian because I want to know what my FICO scores are. And then some people say, hey, I just want Credit Karma. So I can have free and I can have,
And then your book.
And my book. It's on my website and it's on Amazon.
Okay.
It's called A to Z Credit. I have a copy with me. Yes.
Love it. I don't see any other questions. Let me see. I want to make sure I covered everything. So velocity banking can increase my credit score if done properly, the way I tell people to do it. Sometimes, so just to recap, velocity banking, we might sometimes have to put it on hold if you're trying to acquire something, a home, a car. In my case, I'm trying to get 2 more leases. I'm actually looking to put one of the leases on my mom's name,
Mm-hmm.
and so I don't have to be on that.
Mm-hmm.
And then the second, I was planning on running it through the business.
Okay.
What does that do?
Oh,
in
that's
terms
beautiful.
Of that
And
would
it's for your car?
alleviate pressure on my
It would
personal.
alleviate pressure on your personal. Then you can also get business car insurance, which is a lot cheaper than regular
Really?
insurance.
Really?
Yeah, you pay like $30 to $80 for
What?
business insurance. Oh, I cannot wait. As soon as I move, that's the first thing I'm doing, is getting business insurance. If you have a business, LLC, S Corp, something, get you some business insurance for your car so that you can go away from that.
Okay, so
Raggedy.
so the last thing I want to cover is should a 850, because you see all these videos on YouTube, they get tons of views where it's like how to get the perfect credit score, get the perfect credit score. Should a perfect credit score be the goal?
I say yes and no.
Yes
It should be the goal because you want to shoot for the stars, so that if you don't hit 850, you still fall somewhere in between by adapting those behaviors. That's why I said the 10% rule, because the 30% rule can get you within the 700s, not a problem.
Right.
But the 10% rule can take you that extra mark, right? So it's more so, make that a goal of like, yeah, this is what I want to do, but understand that you may fall somewhere in between there just because of how things average out with the negative items you may have on your report. It's going to, especially if you're looking at a specific time frame, you don't want to beat yourself over the head like, I'm giving myself 4 months to have 800 credit score, because sometimes that's unrealistic, right?
Okay.
So don't make that the main focus, but shoot for the stars, of course.
And so for those that are doing velocity banking, that you're paying off debt, something that I tell them to do on a yearly or every 6 to 9 months is to increase the revolving accounts.
Yes.
So that as you're paying off more and more bad debt, if you continue to increase your credit lines, doesn't that also reduce my utilization?
Yep. It
So I
reduces
can get closer and closer to 10% just by increasing those credit lines. So here's something that I'm, I get a little happy with it sometimes. So sometimes I get denied, sometimes I get approved. What is a happy medium balance in terms of the time frame and how much should I be increasing my credit lines by?
So that's a little bit, that's going to be a little bit different. That's going to vary by lender. And the reason why, because every lender looks at something different. Some are looking at, collection items that you have, your DTI. Some are looking at your utilization or what your previous history has been looking like.
So you would say first, you would say like look or talk to the lenders first.
Ask them what it is that they're looking for. And it's so funny that you said that, because I was actually just going to speak to that as you were, presenting the question. Because I had a client who I told him this. I said, ask them first what it is that they're looking for. He went ahead and asked them. He got approved, and then he got a denial at the same time, right afterwards. And they said, well, after further review, we see that your collections, you had a collection account that was still on there or such. And he did it kind of too prematurely, but it was one of those things where he didn't ask enough questions. You need to know everything that they're looking for. What negative items are going to keep me from, getting this increase. Even though he's been with them for 5 years. He's been with them for 5 years. He's been responsibly using his balance. And he doesn't, he's been applying what I told him to do. But he's only been doing that for the past 3 months. I said maybe we should wait a little bit longer. It was a little bit premature. And then we didn't ask them. But he thought because of his tenure being with them for 5 years, that it was going to be okay. So my first thing would be to ask them, what is it that they're looking for? So we want to know the utilization area that's going to be affected. If I have over 15%, is that going to...
This is for increasing credit lines. So just jot that down. Because this is something that interests me a ton. This is where I'm always talking to my clients about. I'm like, hey, okay, you've had that personal line of credit at $10,000 for 9 months, almost a year. Let's up it up to $15K. Let's get it to $20. Same thing with helocs. As they're knocking down their principal mortgage, I mean, why not get a bigger HELOC? You know, just keep going up from there. So, utilization, negative items.
Tenure, how long you've been with them, because that may be something that's important to them. To some, it may not be. As long as you've been, actively, paying for a year, they may be okay with that. Whereas, they may want to see you for a few years. So utilization, negative items, tenure. As far as the amount, I can't necessarily speak to that.
Okay.
I can't necessarily speak to that because I know everyone is different. So some of them may choose it for you.
So let me know if this is a good idea. So,
Okay.
Let's say someone cash flows $500 per month.
Mm-hmm.
They have a line of credit, $10K.
Mm-hmm.
And let's say they did 2 chunks in 12 months of 66% of the line of credit, so 6,600.
Okay.
Right? So times 2, what is that? 12, 6, 13, 2, right?
Listen now.
I'm the finance geek. So
There we go.
if that's the answer, that's what it is.
That's
so
it.
let's just say that was the amount of debt that I killed in 12 months.
Okay.
And the line of credit at 10K, their cash flow per month is 500. For knocking out 13,200 of debt in 1 year, plus whatever their monthly debt payments were, okay? And let's say their cash flow going into the second year of Velocity Banking is now $750 per month. What I tell them is, let's say the credit union that they have this 10K at, the max credit line that they offer there is 30,000.
Okay.
So here's the information I'm telling them to do: is see where they're at, what's their cash flow, what's their cash flow gonna be, what's the max credit line offered at that credit union, and then we look at. I take the cash flow, 750 times 12 is 9,000, right? And then I say, okay, well, if the max is 30, if I'm cash flowing 9,000 a year now is what I'm going to cash flow. I'm at the beginning of the second year, but I've killed 13,200 in the last 12 months, and the line of credit's at 0.
Okay.
So I also tell them, make sure this is at 0,
At 0 before
or
you do
close
that.
to
Okay.
it before I apply for a new one. I give them this range right here. This is how I come up with the range.
Okay.
I say apply for a 9 to 13,200, and if you want to be super conservative, I'll take that number and cut it into half, the 9K, and just say 5.
Okay. So they would ask for a 5K increase.
Anywhere between 5
and to 13.
to 13,000.
That's not bad.
That's like.
That's not bad, because the
idea.
worst thing they can do is tell you no
And counter.
and counter.
And they might counter you.
Yeah.
Okay.
Which counter is a good thing, because then that means
That you got to prove for
you
something.
got to prove for
It's
something,
better than nothing.
right?
Okay, so yeah, that's what I've kind of
That's
like
safe.
been doing, and because
That's
it makes sense. They know that I killed $13,000 of other debts, and the line of
So they
credit
see you
itself
as
is at
someone
0.
that's trustworthy.
Okay.
They'll be more more likely to give you something. Now this has to, when you're asking for an increase to this capacity, they are going to have to see some work being done. With the guy that I'm working with, he hasn't even gotten to this step yet.
Right.
So that's something else that you want to be, be cautious about when you're, just starting off is, hey, your line of credit, you can ask for an increase, but they may not go ahead and give it to you to this capacity if you haven't, really shown anything like this to actually get approved for that.
Okay, wonderful.
But this is a good thing. I like that.
You like that? Okay, cool. Well, I think that's everything, guys. I don't see any more other questions. Johnny Boy says I tried to connect with Brittany, but I'm not cool enough. I guess. Maybe send you an email or a DM or something like that. Probably missed it.
I mean, I'm here.
I always miss messages all the time.
No,
I
I have them. I have not missed any emails. DMs, yeah, because some DMs, they are
weird, right?
very.
Yeah. I get some weird stuff.
Yeah.
I can only imagine. So, if you guys want to reach out to Brittany, I put her email and the website If you're looking to get a free consultation with a credit professional, credit expert, go ahead and email her so that you don't have to pay on her website.
And you have to say Denzel, because if you don't say Denzel, I'm going to say
Not
you right to the
Washington, Denzel Rodriguez. And you will get, what you want. You'll get that much closer to achieving your financial goals, okay?
And you can reach me on social media if you're a social media guru, or you can reach me via email. And it's Brittany Green.
Love it. Awesome. Well, I think that's everything, guys. Love it. Love spending time with you guys. Hello to Key. Looks like Key came in late in the house, but that's all right. Wish you all a wonderful day. God bless. You can say goodbye to everyone.
Bye, guys.